The illiquidity premium is not a bonus. It is a structural payment for surrendering the ability to exit a position at will. This architectural thesis treats capital as a long-term commitment, essentially renting out an emergency exit for a decade to harvest returns structurally unavailable in liquid public markets. Historically, global alternative assets under management have expanded from roughly $7 trillion in 2014 to over $18 trillion in 2024, reflecting a massive shift in institutional capital. This transition is not a trend, but a structural reallocation of the world's long-duration capital toward private architecture. The strategic objective is threefold: accessing niche return streams like mid-market private companies or infrastructure, dampening realized volatility through infrequent valuation marks, and capturing the genuine compensation reserved for patient capital. However, this architecture requires a specific macroeconomic regime to thrive. It performs best during sustained expansion with moderate inflation, where private equity sponsors can execute operational improvements and exit through IPOs or mergers. Private credit specifically offers a structural advantage in rising rate environments because floating rate instruments reprice upward as the secured overnight financing rate, or SOFR, climbs, a feature fixed-rate bonds lack. Conversely, the denominator effect represents a critical systemic risk. During liquidity crises, when public equity portfolios collapse, the private allocation remains static in mark-to-market terms, effectively becoming a disproportionately large share of the total portfolio. This forces a choice between tolerating an unbalanced allocation or selling liquid assets at depressed prices. This mechanical trap froze new commitments across the industry during the market dislocations of 2022 and 2023, highlighting the vulnerability of even the most sophisticated architectures to sudden shifts in macro liquidity.
The execution of this strategy relies on three mechanical pillars: the compounding engine of private equity and the defensive anchors of private credit and infrastructure. Private equity is the primary driver, with U.S. buyout indexes historically returning 15.25% over a 10-year horizon, generating a value add of 200 to 500 basis points over public benchmarks. However, investors must distinguish between buyouts, which apply operational leverage on mature businesses, and venture capital, which is power law distributed. In venture capital, fund returns are typically determined by only 1 to 3 investments. Without a unicorn, these funds often underperform public markets net of fees. A central concept here is the J-curve. In the initial years, management fees and conservative valuations result in negative returns. Realizations only occur between years 5 and 10. Exiting early via secondary markets often forces a loss of 15 to 30% below net asset value. Furthermore, manager selection is paramount. The gap between top and bottom quartile managers exceeds 1,000 basis points, making manager access a fundamental risk factor. Defensive anchors provide the portfolio's ballast. Private credit, specifically direct lending, currently delivers approximately 9% annualized returns compared to 5.2% for public high-yield bonds. This yield compensates for complexity and the origination expertise required for deals that never appear on a Bloomberg terminal. While the IMF notes that subjective valuation marks can suppress reported volatility, the income remains robust in higher for longer rate environments. Infrastructure adds further stability through contractually predictable revenues, often spanning 20 to 30 years with explicit inflation linkage. These assets, such as data centers or power grids, possess physical moats that are near monopolies in their markets. According to Amundi's 2025 projections, adding these assets can increase expected portfolio returns by 50 to 100 basis points per annum without a material increase in risk.
The final consideration involves the mathematical vulnerabilities and governance requirements of an alternatives integrated portfolio. While reported correlations appear low, this is often a function of lagged valuation conventions. Research suggests private equity carries an economic beta to public markets of 1.2 to 1.5. In a systemic event, such as a stagflationary recession, correlations that appeared near zero can drift towards 0.8, eroding diversification benefits exactly when they are needed most. Additionally, the typical 2 and 20 fee structure creates a significant drag. A fund with a 9% gross return may only deliver 6 to 7% net to the investor. When compared to the long-term performance of a passive S&P 500 ETF, the illiquidity premium must be scrutinized net of all costs, including the cash drag from maintaining liquid reserves, usually 1.25 to 1.5 times the committed amount, to meet unpredictable capital calls. Strategic execution therefore requires a sophisticated rebalancing algorithm and tax governance. Unlike liquid portfolios, private assets cannot be rebalanced on a calendar basis. Instead, investors use pacing studies to manage the timing of new commitments across different vintage years. This vintage diversification smooths the performance variance seen in historical cycles. From a tax perspective, private equity distributions often qualify for long-term capital gains, while infrastructure and real estate provide depreciation pass-throughs. Private credit is most efficiently held in tax-advantaged accounts to shield ordinary interest income. Ultimately, the illiquidity premium is a genuine structural return source, but it is reserved for investors with 10-year horizons and the institutional discipline to manage complexity. It is a deliberate trade-off, accepting a capital lockup and manager risk in exchange for a superior inflation-linked compounding engine that public markets cannot replicate.